Colleagues, it's 2:09 p.m. Sebata here once more. I'm just going to make a short video. Had a chat with one of my friends. They are thinking about investing. And they had a question for me. And the question was, how do they choose the stocks to invest in? And automatically to me, I had lots of questions. And my best advice to them was stop. If you are going to ask that question, stop. Let's go deep. Let's go do some critical thinking and come up with some real solutions. Because once you ask that question, what comes to my mind is that you don't have the framework of how to invest. You don't have an investment philosophy. And you have not broken down to first principle as to decide what to invest in. So I'll break it down a bit. In the investment game, they have a name for it. They call it due diligence. You have to do some due diligence, but within a certain framework. And I'll just drop some ideas here, but I'll really want to deal with this one in more depth. When I deal with it in more depth, I'll be looking at I'll do a real video and go through how to screen your stocks and decide which ones you want to go with. But since I'm doing this video in the bush, I'll deal with the cattle. Let's suppose you now want to be a cattle farmer. You want to buy some cattle. You're going to choose the type of cattle which survive best in your region. The type of cattle which, when you sell them, you're going to get more out of them. Or they are dairy cattle which produce the most milk. You're not just going to buy anything. So basically you are looking at their history, how they have performed in the past. Are they good for this region? Are they good for these times? Same with investing. What are you investing in? Does it produce the best returns? Most people will jump into what's trending currently: Forex, cryptocurrency. Do you know how it performs? Is it actually an investment? Those are the things which you have to critically apply your mind to, critically think about them. There are levels in this investment game. I'll take it this way, give you some basics of them. Stocks are at the bottom. These are shares. They are relatively safer. Then we come up to CFDs. One level higher, we've got Forex. Going higher, you have warrants, options. That's the top. Then you have cryptocurrency. They are really volatile. If you want to play the volatile game, play them. But as long as you are playing at that level and you are using stop losses, I've got news for you. You've got one hand on financial disaster. You are pulling the lever for financial disaster. But going back to stocks, for me it's an easy game, but most people don't get it. They really don't get it. When it comes to stocks, you want to buy those stocks which have been compounding greatly. I'll give you an example. Stocks which on an annual basis you expect a return of 20% or more. I'm talking about stocks which have a gross profit of more than 50%. Net profits, net income above 20% of their revenue. You can easily screen those stocks and get them. You don't need lots of them. If you end up with 10 of the best, that's all you need. Most professional investment managers will have returns, annual returns of less than 20%. Yet we know there are stocks which return more than that. Go pick Visa, MasterCard. Their returns are always above 20%. The annual aggregate returns are above 20%. And you take your money, you give it to a money manager who returns 10% or under 10%, and they tell you stories that the average for the S&P, whatever, all along has been in the region of 10%. But there are stocks which have averaged above 20%. Guys, let's think. Let's apply our minds and do the best for ourselves. Just because institutions cannot invest so much money in those shares to get those kind of returns doesn't mean that you have to limit yourself also. Most of these money managers are underperforming the top stocks. We have stocks like Adobe. They're always returning more than 20% returns. But I'll go into the depths of those. But those are the kind of stocks which you need. Even Warren Buffett had to say it. He said if you had to give him $1 million to manage, he will definitely guarantee to give you a return of more than 50% annually. It can be done. And there are questions which you need to ask yourself. I'll do a proper detailed video on this one. What is the value add of the person who's managing your money for you? Did they tell you? What are they actually adding value to you? What differentiates them from the others? Are they solving their problem or your problem? Is it a problem or is it a need which is being solved by these people when they say they are managing your money? And you yourself, if you are doing your own investment or thinking about doing your own investment, what problem are you trying to solve? How are you going to add value? Yes, you will pay. That's a given. But look at it this way. Is the cost benefit in your favor when you do it for yourself, when you give more money to the other person? Have you analyzed that? How do you analyze that? I'm a financial teacher. Let's work together through this route so that you can do a proper job of it, because it's your money and you don't have a lifetime of earning unless you build a system. There are black swan events, things which can be tragic, which can happen, which we cannot forecast, and they can come and swipe all your money off and your investments. Have you built a hedge? Are you protected against those? If the markets crashed today, will you still return your money or will it be gone? Is your money insured? Most of us have our cars insured because the financiers forced us to get insurance. So if the car gets messed up, you can get it back. The insurance company can pay for it and you can get it back. But your actual retirement money, your actual legacy is not insured. It's just sitting there waiting for somebody to make a business out of sniffing it out of you with your eyes wide open. Get your portfolio insured. It's not an option. They always say the house always wins. That's the saying which goes around in gambling circles. They say the house wins. But we know the insurance, the gambling model, the casino model. Why don't you apply it to your own life? Why don't you become the house? Why don't you get your investments in such a way that you are the house and you always win? Go and see a financial advisor. Once they start saying, yeah, you win some, you lose some, run away. Ask them, why do the house always win and you're telling me that I lose some, I win some? No. That's lazy logic. If the casinos always win, why not you? Go into any town. Look at the biggest buildings, insurance companies, banks. They've designed their model, they don't lose. Those guys always win. Even in a crisis, they get bailed out. Design your financial investment model so that you always win. You are like a casino. That's the only way. This has been Tusanang, PM Sebata, your financial teacher. This was just a teaser. We're going to look into this topic in a little bit more depth. But design it, build it, so that it lasts for generations to come. Set up that foundation. I don't care whether you started off with a foundation or no foundation. Set a foundation for the future generations. Be a generational builder. A financial corner house. not just a cornerstone. I thank you. So long. Let's build this circle. Cheerio.